And a very warm welcome to our next quarterly update. I'm joined here with my friend and colleague, Will Kent. And I think we can safely say, Will, I'm actually very glad that end of financial year is over for us. Notoriously is the busiest time of the year for us, but we made it through. We made it through.
Barely, it seems, but yes, we are on the other side.
And I suppose, it's always just good. It's always a good timely time for an update just regarding, just the past 6 months. I feel like there has been a lot of headlines. There's been a lot of news. There's been a lot of ups and downs. And it's just, let's just take focus on what has actually happened and what we sort of look at for the next 6 months. You know, we've seen multiple wars that have happened in sort of the past 6 months. There's been geopolitical changes. There's been lots of, talk about Australian property. There's the budget, which was, I suppose, quite a fundamental shift in how Australians think about investing and how we think about structuring our investments going forward. And then on top of that, cost of living pressures, inflation still continues to remain sticky. But I suppose, what we'll dive into each sort of point more, I suppose, more micro focused, but, headlines are noisy. Sometimes it's best to just sort of read through it, understand where you're at the moment, and think, right, how am I going to move on from this and where do I need to ultimately end up? So, blocking out that news, global markets.
I think you've hit the nail on the head there, Joel. There's a lot that we need to cover off today. I think we could talk for 3 or 4 hours on the last quarter that's happened. Between the AI boom, as you said, wars, inflation, the property market, the budget here in Australia. We could go for quite a while. So we'll try and make it as succinct as possible today for everyone. But yeah, global markets, we'll start there. Really, the one thing that dominated the second quarter with global markets was resilience, right? Now, as we said, there was wars, elevated oil prices. The media love to speculate day in, day out, as attention is what draws clicks, inflation, interest rates. But through all of that, equity markets actually continued to perform quite strong. The US market reached new highs. We saw Japan and emerging markets actually outperforming many developed markets during the quarter. And again, this has really been led, as it has been for the last couple of years, by the information technology sector. And we're seeing that a lot recently in the last few years, obviously with AI and all the spending and stimulus that's going through there. But what was really fascinating is that markets have largely looked through all of this geopolitical noise. The budget that we saw in May caused a bit of a stagflation, I suppose, in the property market here in Australia. But when we look globally, there's been so much noise with everything going on in the US, everything going on in the Middle East. But yeah, really, the equity markets continue just to rally on in the background, which is really fascinating. Historically, investors often expect major global events to derail markets, and we didn't really see that happen too much this time.
You touched on sort of AI there, and that has been, I suppose, a very topical point for a lot of conversations that I've been having. And what does that actually mean? Like, what AI has just sort of been this really topical feature over the past, even 3 to 4 years. And it's been somewhat exciting. And it's been, right, well, what is the next best thing? What does it actually do for us as a society? And what does it do for, our work? Ultimately, I know single-handedly it helps us greatly in doing things like reporting and analytics. But companies obviously have been spending lots and lots of money on AI. And this is sort of approaching its proving phase. What is the cost of AI inverse of human capital? They've spent lots of money on building data centers, computing capacity, next level infrastructure. And there was an article which I read just recently, and it was like, right, well, spending on AI related capital could exceed $1 trillion annually. And now, so that is enormous. And, it's at what cost to us? And, we've even started to see some pollies in Australia talk about, right, well, how how is that going to flow through to benefit all of us? Is there going to
Mm.
be a taxation then on AI? Because ultimately, is it replacing jobs? Is it replacing, the work that would ordinarily be done by people? So there's enormous demand coming through from that sort of AI space. But I suppose the proof will be in the pudding in a couple of, in the next sort of phase. We are looking sort of beyond right, everyone can have a new AI, idea. They can have a new program that's going to do this amazing stuff, right? Well, as investors, we say, that's great. When is it going to turn a profit?
Yeah.
When is the money going to start showing in this AI story? Because so far there's been a lot of capital that's gone
Mm.
into it. Now it's time for that sort of ROI on that capital that's come through. So I think, more broadly from an AI investment standpoint, this is something that is going to be, a really good watch this space over the course of the next, even 6, 12 months as, over and more broadly longer term. So yeah. And I think it will
Yeah.
really shape how we look at financial markets over the next decade.
And we're starting to see that profitability come through, right? Like I saw an article, must have been 3 or 4 months ago, and it was stating that on average in the AI space, it was about 81% more profitable than the year
Mm.
before. So it is
Yeah.
starting to feed through, but it does take time. But yeah, definitely, if you've been invested in the AI space for the last 2 or 3 years, you'd be happy right now. The markets have gone very, very strong, but we obviously always want to have that diversification because you wouldn't want to take on too much risk in that space, as you've stated. Look, let's talk a bit about the global economy. So really surprisingly, the global economy has been very strong and very, very solid, I should say. At the start of the year, many investors were really, really worried. We had obviously everything going on in Iran. We had the higher oil prices, all the conflict there. We had stubborn inflation around the world. But really, labor markets have been strong. Consumers are still spending. I know I'm going over to the US for a short little holiday at the end of the month. As a consumer, I'm spending. And
Isn't that a
corporate
problem
earnings
for the inflation though?
well, it's a problem with the current exchange rate that has gone
Yeah.
back up again. So it's costing me a bit more than what I'd like. But yeah, even corporate earnings have generally held up quite well. So this global growth is continuing. Now, look, albeit it is at a slower pace than what we saw post-COVID, but it still is really tracking along. And I think it's interesting because a lot of economists at the start of the year were not predicting this at all. Energy prices remain elevated, supply chains have improved, but aren't perfect, and global demand really remains quite strong. I think though inflation is still the bugbear for a lot of people, a lot of countries. It is definitely here in Australia, and we'll cover off that a little bit later. Really, it's quite sticky, and we just can't seem to get it down to where we want it to be. So I don't think we would declare victory as of yet with the global economy. But yeah, time will tell, depending on what inflation does and which way that tracks around the world.
And I think whilst inflation remains notoriously sticky, as you said, I think you can expect that the reality of that is that interest rates, both in Australia and probably more broadly globally, they will remain high for longer. And, I don't anticipate, that's going to be have any sort of drastic change over the course of the next 12 months. So yeah, well, you're heading off to the US, so I can just give a bit of a synopsis on what happened in the US, right? In the last quarter, take this sort of somewhat with a bit of a grain of salt because Trump started a bit of a war with Iran, which caused a bit of a short-term blip in the markets. So what we have seen overall is the Nasdaq, that's currently up about 20.6% for this quarter. S&P 500 up 13.81%. Overall, though, you know, Trump, it was so funny. I've seen Trump's tweets. He's like, "Oh, the stock market in America is doing great," and it's of course, he's a populist, so he caused all of that, of course. But naturally, the US market continues to show that resilience. Labor markets have been consistent throughout the US. Probably the bigger thing there is right: is the US market actually growing? We want to see, that economy growing on scale year on year. And, what sort of largely has dominated the US economy more broadly is those sort of tech stocks and the sort of wonderful seven. They're very concentrating when we look at those market indices. So it's really important, I suppose, to consider, right, well, we don't know what's going to happen over the course of the next 6 to 12 months. We don't want to have complete emphasis and concentration in our portfolios, on those sort of magnificent seven. The impact, as I said earlier, of AI is going to change. It's going to shift the way that, we work, and what does that actually mean? And, more broadly, companies are going to want to see that growth. As investors as well, we want to see our money doing well and the US economy growing. So it's a bit of a watch this space, particularly for the US over the course of the next, 6 to 12 months.
Yeah, and I think even too, when you extrapolate that further out, like Trump has
Mm.
been spending a lot of money during his second term. Like his big beautiful bill was effectively, could have been called the overspending bill for all rights and purposes. It was let's spend as much money as possible, is what it read like. So it'll be very interesting to see not just the next 6 to 12 months, but the next 3, 4, 5 years as Trump's second term ends. If he decides to leave the
Yeah.
office, as some are speculating that he potentially won't. It'll be very interesting to see, what will happen thereafter. Obviously, the US election that will come up, and potentially the US government maybe reining in a lot of spending and what impact that may have on markets. So, yeah, definitely a space you want to be well diversified in and not just really concentrated, as you've said, those magnificent sevens. Now, emerging markets in Asia as well. Really, really interesting story here. So the Shanghai index is up about 5.2%. Hang Seng was down 7.69% for the quarter. Many emerging economies have proven to be very, very resilient, even despite energy shocks and a lot of the geopolitical uncertainty that we've had. So, emerging market equities actually outperformed developed markets during the second quarter, which was great to see, I suppose, if you're in that space. I know a lot of our portfolios have some exposure to these emerging markets, but a lot of people just buying a simple index or whatnot don't. So again, just really shows you the importance of diversification here. And then moving on to China. China was a really interesting story. Growth is moderating in China, but policymakers, they continue to focus on stability, advance, manufacturing, and really that long-term economic resilience there in that country. China, it's always an interesting story, China, right? I mean, depending on which way you look, you can hear a good story or a bad story about their economy, about their market, and about the anticipation of where it's going to go. And look, whether that's, semiconductor space, critical technology infrastructure space, like the whole of Asia really remains quite strong. And it's an area that I know we are keeping a very, very close eye on in our portfolios. The Chinese market, the Asian market as a whole, the Japanese market specifically too.
Mm. The Asian market, I think, just more broadly has been somewhat overlooked for many decades. It's been quite juvenile, and as we
Mm.
see China sort of start to flourish into, you know, the largest economy in the world, there's going to be a lot of, again, focus on, right, well, what does that actually mean in regards to even the sort of AI beneficiaries through that sort of Chinese supply chain. Turning now, obviously, Australia. Australia is always much more topical, and I think over the past quarter, I've had more conversations about Australia than any other time. With the budget that's happened, I think, what has sort of really shown through is that sort of inflation issue. You know, Households are more broadly feeling that sort of cost of living pressure. The Reserve Bank is trying to balance that. But, with that inflation data still remaining sort of consistently sticky, RBA, as I said, not going to be in any rush to reduce interest rates over the sort of short to medium term. But overall, Aussie equities, performed relatively flat compared to obviously other markets throughout Asia and the US, with the All Ords was only up about, I think it was just under 1% for the quarter. So I think it's going to be really important to factor in, right, what is the broad market play? for Aussie equities. And, largely Australia generally has quite a home bias. And so because of our currency being a sort of more commodity backed currency, there is that sort of bias towards Aussie equities, and Australia's sort of stock market more broadly is just really concentrated towards banks and resource companies, of course. So, and in both of those sectors, they're sort of facing their own challenges. Naturally, the resources sector wants a quite a soft Aussie dollar, so that they can export as much as their goods and services, and the banks naturally want a nice healthy margin on their borrowing rates, so that they can make and remain profitable. And that's why I think, again, more broadly, we think about portfolio diversification. Let's try and look beyond, the big powerhouses in Australia. If you're sort of just looking at an index option, for example, in Aussie equities, well, it's going to be like 30 or 40%. It's going to be the sort of the top five: Commonwealth Bank, CBA, Rio, BHP. These are going to be quite concentrated in that investment. So just sort of looking beyond that, and just knowing that diversification is going to be the real success story there. And then there's obviously the budget. I think we did a whole podcast on the budget, and please, by all means, tune into that at Money Side Up podcast. Yeah. What's your take? Just for
I don't know how succinct I can make this. Yeah, for a short video that we're trying to record, I'm not sure how succinct I can make this, but the budget was it was one of the most significant shifts in Australia in the last 20, 30 years. They completely rewrote the tax system primarily for investors. So three big changes that we saw, right? Change around trusts, change around the capital gains tax, the 50% discount, and changes around negative gearing. If you turn on the TV, look at any news article or news website, one of the first headlines you'll see is something to do with the budget over the last 8 weeks, probably even longer. It has been such a speculative topic people are talking about. It was, what's going to happen and how has it happened? To be honest, though, it seems like they didn't put much thought into it. So as soon as they announced all these changes, they backtracked so many of them straight away. So it really is very, very important when it comes to things like the budget that you wait to see what's actually legislated as opposed to what's just announced before going and making any drastic decisions. But really, yeah, look, the government is signaling that long-term wealth strategies need to be more deliberate, more structured. I think around the budget and around these changes, it's really showing the importance of having good structures in place. So superannuation, still one of the best structures you can have in Australia for tax effectiveness. But again, everyone's situation is different, so it's always important to obviously get advice. But yeah, this budget really has just emphasized that, the importance of structures, the importance of having a good solid plan, and the importance of making sure that plan is flexible and adaptable. So as things like, the CGT 50% discount gets taken away, you can adapt your plan and make sure that you're still as tax effective as possible. But yeah, look, as I said, I think I could talk about the budget for hours. I've been quite vocal with a lot of my clients around it for the past few weeks. And obviously the impacts have been having lots and lots of calls about what it means for people's specific circumstances. But I think that the key thing is make sure your strategy is adaptable, make sure it's malleable enough that you can, move in and out of what you're trying to do and adapt that strategy as time goes on. But yes, we've seen already some things become legislated. So the CGT discount was legislated, the negative gearing changes were legislated, but we still haven't seen the change to family trust, discretionary trust being legislated yet. So again, there could still be some changes there that we'll keep our ears to the ground for.
Absolutely. And, that the negative gearing was probably the most fundamental change for the budget. And that sort of flew lots of commentary through into property, right? So ultimately, every sort of morning you're looking at this, property prices are going to collapse in Australia. This is, doomsday once again. But I don't think that, that's broad. I don't share that same broad consensus.
Me neither.
Before I think, negative gearing it obviously has been a very important tax policy, and a lot of people have relied on those sort of tax benefits to sort of justify those investment decisions, particularly within property. And I think that will fundamentally change going forward, property, if we look at where good growth has happened within that sort of property market in Australia, it's been where, the good blue chip neighborhoods, it's where is the population going to grow? If Australia continues to have, you know, higher levels of migration into the country, right? Well, where are they going to live? Where are the jobs? Where is that demand going to come from? And I think, there might be areas in Australia completely that will slow. There will be, for example, um, potentially regional areas in Australia that will slow or reduce. But,
Yeah.
it's going to come down to good fundamentals and economics if you're still looking at property. And I still think it plays a very important role in that sort of diversified wealth strategy.
I think
The
at the end of the day in Australia, there's 5 places that people want to live, you know,
mm,
Sydney, Melbourne, Southeast Queensland, Perth and Adelaide, probably the main 5 areas. And like you said, there's a big difference between, when you're buying a property and it's for the numbers, so it's an investment, what's it mean for my wealth building, or whether it's your home. But I think you hit the nail on the head there, Joel, that we will see probably regional areas, tend to slow down. A lot of these property spruikers that you see might be out of work, depending on what the market does. But, if it was a good asset yesterday, chances are it's probably still a good asset today.
Absolutely. And yeah, just maybe just sort of thinking about this, right? Well, are we taking it completely off the table? No, we're not. It's still a
Mm.
great asset class to continue to grow your wealth. And, you are in most instances using leverage to move your wealth. But it's got to play a role. And, once again, looking at the fundamentals, we want quality assets in our position rather than just any asset, and sort of avoid the sort of short-term speculation property bump, I would say. Mm.
Yeah, I agree entirely. The quarter ahead, then there's 3 key things that we have discussed that we really want our clients and obviously anyone else who's listening to this as well to focus on. And really that is focus, flexibility, and resilience. So focus when it comes to building the plan out for the next quarter and the long-term strategy. We really want people to focus on where your returns are coming from. The market is becoming increasingly concentrated. And I love this quote that, yesterday's winners won't be tomorrow's winners, or may not be, I should say. So really, really important. Just because something's done something historically doesn't mean it will continue to do that. So have focus around your strategy. As we touched on before, flexibility. Again, the budget's shown that massively, right? The ability to pivot your strategy, to change your direction, to move things around and have that flexibility whilst you've still got that stability of growing your wealth is very, very important. And then thirdly, resilience. I mean, we've seen it in the markets very strongly for the last couple of years. We had the pandemic. We had 2022. The tech sector was down. I think Sydney property prices were down 15%. It's bounced back quite strongly, obviously, in the last 4 years since then. So again, staying resilient with your portfolio, staying resilient with your strategy, and making sure that you're buying good assets from the start that can get you to where you want to be long term, and you've built that resilience around your portfolio is really, really key.
That's it. Yeah. And, just sort of looking forward, now is an ultimate time to be really checking in, particularly if you're living in Australia with these changes, the rest of this sort of 2026, 2027, um, financial year. It's planning for what are those upcoming changes that sort of could take effect from the 1st of July 2027. We still see plenty of opportunity across the board in both, most asset classes. The sort of market has proven to us time and time again that we are a resilient sort of global economy in its entirety. So whilst inflation still remains somewhat sticky, interest rates are going to be high. We're going to be sort of looking at, once again, that quality end of any sort of assets, and sort of reading through the headlines and saying, right, well, yes, there is a lot of noise, but what is right for you? And every client is going to have their own individual set of circumstances. They're going to have set of goals that are different, and just being adaptive and understanding, right, where am I at the moment, and what do I need to do to move to the next phase? We're always planning. I know in our investment discussions, we plan in cycles, right? So that could be 7 or 10 years. I'm definitely not here to try and sort of shoot the lights out tomorrow and become, an overnight millionaire. It's about good fundamentals and saying, right, well, what's important for me? Where am I going to be in 5 or 10 years' time? And am I going to be happy with that? So just sort of rounding out our sort of discussion, now is the time to, check in with us. Will and I, we really enjoy having meetings with our clients. And if you're watching this sort of for the first time, then booking for a chat. It's time to sort of realign for goals. That's what we're here for. We're not AI chatbots. So, we'd love to help, obviously, just continue to align that going forward.
Yeah, seconding those thoughts. I think it's when we have these conversations with each other, when we record these, we talk in a general sense about the broader impacts and broader economies, but there's no better strategy than sitting down and talking about you specifically, which is obviously what we do with you guys, the clients. So yeah, book in a chat. Never feel like you're reaching out too much. If you have to ask us questions or want to book in a time and run through the situation, it's what we're here for. And it's what we love doing.
Absolutely. Thanks so much for tuning in, everyone.
Thanks, guys. Until next time.